Imagine it is October 1930. You are a grain farmer in rural Nebraska named Harold. You have worked the same land for 30 years. You understand soil, weather, seed, drought, debt, and patience. You are not a speculator. You are not trying to get rich quickly. You are trying to survive the winter and plant again in the spring. A month earlier, you sold your harvest and deposited $4,200 into the First National Bank in your small town. That money is not an abstraction to you. It is not a number on a screen. It is a year of labor. It is next spring, seed. It is food, heat, feed, tools, and the ability to keep your family going when the weather turns cold. On Tuesday morning, you drive into town to withdraw $80 for supplies. When you arrive, there is a line outside the bank, a long one. People are not acting normally. Some are whispering, some are shouting, some are standing very still. The way people stand when they are trying not to panic. The doors are locked. A handwritten sign is taped to the glass, closed until further notice. You push forward, you knock. A clerk inside looks at you, then looks away. He shakes his head. He does not open the door. He will not make eye contact. Your money is still inside. You can see the building. You can see the vault. You know the account is yours. You know you earned it, but you will never touch that money again. Not $1. The bank has failed. Your deposit is gone. There is no insurance. There is no appeal. There is no customer service department that can solve it. There is only the fact that the machine broke. And when it broke, people like Harold were last in line. Within a few years, thousands of American banks would close their doors in the same way. A large portion of the money Americans believed they owned would disappear. Not because it was gambled in the stock market by the depositors, not because it was wasted, not because they were irresponsible. It was deposited, it was trusted, and then it was erased. That is not a story about the past only. It is a story about how financial systems work when confidence breaks. The names change, the laws change, the language becomes more sophisticated. Regulators create new terms. Politicians make new promises. Institutions build more complex systems. But the core principle has not changed. When you put money in a bank, you are not placing cash in a private vault with your name on it. You are lending money to a financial institution. That institution owes you. You become a creditor. And in every system, creditors exist in a hierarchy. Most people do not think this way because most of the time the system works. You deposit money, you use your debit card. You transfer funds, you withdraw cash. The system feels like ownership because access is immediate. But access and ownership are not the same thing. That distinction matters most when everybody wants access at the same time. I have spent much of my life studying how financial systems behave under stress. I do not look at them as moral stories. I look at them as machines. Machines do what they are designed to do. If you understand the machine, you can deal with reality. If you do not understand the machine, reality eventually deals with you. A bank is not a vault. A bank is a counterparty. That is the principle that most people miss. When you deposit cash into a checking account or a savings account, the bank takes that cash and records a liability to you. On your side, it feels like an asset. On the bank's side, it is a promise to pay. The bank then uses the money. It lends it. It invests it. It buys securities. It transforms short-term deposits into longer-term assets. That is the business. It can be useful. It can create credit. It can help economies grow. It can finance homes, businesses, farms, factories, and trade. But it also creates fragility. Because the bank's liabilities are short, term depositors can demand their money quickly. The bank's assets are often longer. Term loans cannot always be called back immediately. Securities cannot always be sold without losses. The timing does not match. This is called a maturity mismatch. It is not a mistake in the system. It is the system. It works in calm periods because not everyone wants cash at the same time. The bank only needs to keep enough liquid reserves to meet normal withdrawals. As long as confidence remains intact, the machine appears stable. But confidence is the load-bearing wall. When that wall cracks, the math changes immediately. In 1929, people remember the stock market crash. They remember Black Tuesday, they remember panic on Wall Street, but the deeper economic devastation came later, and it came through banks. The United States had thousands of commercial banks. Many were small, many were local. They took deposits from farmers, merchants, families, and businesses. They operated within a fractional reserve system. That means when someone deposited $1,000, the bank did not keep all $1,000 sitting in the vault. It kept a fraction and lent the rest. That loan became another deposit somewhere else. That second bank lent most of it again. The process multiplied credit across the system in good times. This looked efficient. In bad times, it revealed the danger. The system had created more claims on money than money actually existed in immediately available form. That does not matter when claims come slowly. It matters completely when claims come all at once. A rumor starts. A bank fails in one city. People in another town hear about it. They think, I should get my money out just in case. That thought is rational for the individual. But when enough individuals think it at the same time, the system becomes unstable. Just in case becomes the cause of the failure. The bank run is one of the clearest examples of how human behavior and financial structure interact. The structure is fragile because deposits are short-term and assets are long-term. The behavior becomes dangerous because fear spreads faster than facts. When fear meets fragile structure, the result is collapse. Between 1930 and 1933, thousands of banks failed. Deposits were wiped out, families lost savings. Businesses lost payroll accounts, farmers lost seed money. People did not just lose investments, they lost money they thought was safe because they did not understand where the money actually was. That is the real lesson. The question is never simply, is my money in a bank? The question is, what is my claim? Who owes it to me? What stands behind it? And what happens if many people demand the same thing at the same time? After the failures of the early 1930s, the United States created the FDIC to restore confidence. Deposit insurance was a response to a breakdown of trust. It told depositors that if a bank failed, they would be covered up to a limit. That was a powerful stabilizer. It helped stop the kind of panic that destroys banking systems, but it is important to understand what deposit insurance is and what it is not. It is not magic, it is a confidence mechanism. The insurance fund has resources. The insured deposits in the system are much larger than the fund. That is not unusual for insurance. Insurance is designed around probabilities. It can handle isolated failures. It is not built to pay out every claim in a systemic collapse without outside support. If one small bank fails, the mechanism can work smoothly. If several large institutions fail at once, the system needs additional support. That support may come from the Treasury, the central bank, emergency lending programs, or new money creation. At that point, what people call insurance becomes part of a broader policy decision. That does not mean the FDIC is useless. It means people should understand what it is designed to do. It is designed to maintain confidence and handle manageable failures. It is not a personal vault holding a separate pile of money for every depositor. When Silicon Valley Bank collapsed in 2023, most of its deposits were above the standard insurance limit. The government chose to protect all depositors because policymakers feared contagion. They used a systemic risk exception and created emergency support. That decision may have been the right decision under those circumstances. But it was still a discretionary decision. It was not the same thing as saying every uninsured depositor and every future failure will always be made whole, no matter the size, no matter the politics, no matter the cause, no matter the institution. When your deposits exceed the insured limit, you are not dealing with certainty. You are dealing with a probability distribution. You are depending on the state of the system, the political incentives, the risk of contagion, and the willingness of authorities to intervene. That is not the same as safety. It is conditional safety. And conditions change. This is why I always come back to principles rather than slogans. The slogan says, your money is safe in the bank. The principle says, your deposit is a liability of the bank, protected up to a certain point by an insurance system that works best in isolated failures and depends on policy action in systemic crises. The slogan is comforting, the principle is useful, and in money matters, useful beats comforting. Now look at Cyprus in 2013. The banking system there became insolvent. The government and European authorities did not simply protect everyone and move on. Depositors over a certain threshold were hit directly. Some uninsured balances were converted into bank equity or written down. This was not called a robbery, it was called a bail, and the language matters. In a bailout, outside money is used to save the institution. In a bail-in, creditors inside the institution absorb the loss. And once you understand that depositors are creditors, the logic becomes clear. A large uninsured deposit is not just cash sitting in a bank, it is a claim against the bank. If the bank must be recapitalized, that claim can be part of the loss-absorbing structure. Regulators prefer bail-ins because taxpayer-funded bailouts are politically expensive. After 2008, voters did not want to hear that governments were saving banks while ordinary people suffered. So the system evolved toward mechanisms where shareholders, bondholders, and in some cases uninsured creditors absorb losses. Again, this is not a conspiracy, it is a machine. When a bank fails, the losses do not disappear, someone must take them. The only question is who. Shareholders are first, then different classes of creditors. Then, depending on the structure and the legal regime, large uninsured depositors can become part of the solution. That is why the difference between insured and uninsured money matters. That is why jurisdiction matters. That is why the legal structure of your account matters. A person who understands this does not need to panic. A person who does not understand it can be shocked when the rules are applied exactly as written. The problem with modern finance is that people are taught to think in conveniences. They think in apps, balances, cards, and monthly statements. They are not taught to think in claims, counterparties, liquidity, seniority, and legal hierarchy. But when the system comes under stress, the second set of words matters more than the first. So the practical question becomes, if a bank is not perfectly safe, where should cash be stored? There is no perfect answer. Anyone who tells you there is selling comfort rather than truth. Every store of value has risks. Every form of safety fails under some conditions. The task is not to find the asset that can never fail. The task is to understand the failure modes and diversify intelligently. Physical cash is the oldest answer. Cash held outside the banking system cannot be frozen by a bank failure. It cannot be bailed in. It does not depend on a brokerage platform. It does not require an app to function. If the banking system temporarily closes, physical cash gives you optionality. But cash has costs. It can be stolen. It can be destroyed. It earns no interest. In an inflationary environment, it loses purchasing power. If prices rise year after year, the cash may remain physically intact while its real value erodes. In a deflationary collapse like the early 1930s, cash can become extremely valuable because prices fall and liquidity becomes scarce. In a high inflation or currency debasement environment, cash becomes a melting ice cube. So the question is not, is cash good or bad? The question is, what environment are you preparing for? Deflationary stress favors liquidity. Inflationary stress punishes idle currency. A balanced person understands both. Treasury securities are another mechanism. When you own short-term treasury bills directly, you are lending to the federal government rather than to a private bank. In the dollar system, treasuries sit at the center of the financial machine. They are collateral for institutions around the world. They are considered among the safest dollar-denominated assets. But even here, there are trade-offs. If you hold treasuries through a brokerage, you have brokerage counterparty and access considerations. The securities may be protected under different rules than bank deposits, but if an intermediary fails, the process of recovering access can be slow or complicated. If you hold treasuries directly through the government's own system, you reduce intermediary risk but may sacrifice convenience, speed, and ease of use. Again, the machine gives you trade-offs. Lower counterparty risk can mean lower convenience. Higher convenience can mean more dependence on intermediaries. Money market funds are often treated like cash. Many people assume they are the same as bank deposits. They are not. They are securities. They invest in short-term instruments. They can be high quality. They can be useful, but they are still funds. And funds can face redemption pressure. In 2008, a major money market fund broke the buck. Its value fell below $1 per share. That event created panic because people had treated the fund as cash. Authorities intervened to stabilize the system. But the key lesson remained. A cash equivalent is not cash. Something that behaves like cash in normal times may behave differently in stress. That does not make it bad. It makes it necessary to understand gold and precious metals sit outside the credit system in a different way. Physical gold is not someone else's liability. It does not depend on a bank's promise. It cannot be printed by a central bank. It has served as a store of value for thousands of years, especially when people lose confidence in paper money. But gold also has problems. It produces no income. Its price can be volatile. It must be stored. It can be lost or stolen. And history shows that governments can restrict or confiscate private gold ownership under extreme conditions. In 1933, the United States required citizens to surrender certain gold holdings. That happened. It is documented history, so gold is not a perfect answer either. It protects against some risks and introduces others. Silver and other metals have their own characteristics. They can be useful in certain environments and volatile in others. The principle is the same. When an asset has no counterparty risk, it often has storage risk, liquidity risk, legal risk, or price risk. There is no free safety. Foreign currencies and foreign accounts add another layer of diversification. If all of your money is in one country, one banking system, and one currency, then you have concentrated exposure to that system. Holding some assets in another strong jurisdiction can reduce that concentration, but it creates complexity. There are currency risks, there are reporting requirements, there are foreign laws for Americans. Foreign accounts above certain thresholds must be reported, and failure to comply can create severe penalties. Offshore banking can be legal, but it must be done transparently and properly. The purpose of international diversification should not be hiding. It should be resilience. If you try to use complexity to avoid rules, the complexity can destroy you. If you use diversification with full compliance and clear documentation, it can increase optionality. Real assets are another category. Land, property, productive assets, commodities, things that exist in the physical world. They cannot be bailed in by a bank in the same way a deposit can. They have utility. A farm can produce food. A home can provide shelter. Certain commodities can preserve value in specific environments. But real assets are illiquid. You cannot spend a farm at the grocery store. You cannot quickly divide a house to meet an emergency. In deflationary crises, real asset prices can fall because credit contracts and buyers disappear. In inflationary or currency debasement environments, real assets often do better than paper claims. Once again, the right answer depends on the kind of storm you are preparing for. This is why the strongest principle is not to predict perfectly. It is to diversify across different failure modes. Most people try to ask, what is the safest thing? A better question is, what are the different ways the system can fail? And do I have exposure that survives more than one of them? If the bank fails, do I have all my liquidity trapped in one institution? If inflation rises, is all my safety in cash? If markets close, is everything dependent on a brokerage platform? If policy changes, am I concentrated in one legal regime? If I need funds quickly, are all my assets illiquid? The goal is not paranoia. The goal is robustness. Robust systems do not depend on one assumption being right. They are built to survive because they have redundancy. A farmer does not store all seed in one place if he understands weather, pests, fire, and theft. A bridge is not designed around average weight only. It is designed around stress. A good portfolio and a good cash strategy should be the same. The trap is that the modern system encourages concentration inside the system. It rewards convenience. It normalizes single account thinking. It makes holding physical cash feel strange. It makes owning metal feel eccentric. It makes foreign accounts feel suspicious. It makes people afraid of looking cautious. But history does not care whether preparation looks normal. History rewards optionality in every banking crisis. Those with options suffer less than those with none. In the early 1930s, many small depositors had no political power, no access to legal sophistication, and no alternatives. They trusted the local bank because that was what respectable people did. Then the bank closed. In Cyprus, large uninsured depositors paid the price of the banking system's losses. In Argentina, bank accounts were frozen, and deposits were forcibly converted. In Greece, withdrawals were capped. In Iceland, capital controls lasted for years. Every situation was different, every legal structure was different, every country had its own explanation. But the pattern was the same. When the system is under stress, access becomes more important than balance. A number on a statement is not the same as usable money. The people who learn that lesson during the crisis pay tuition in real time. The people who learn it from history pay much less. Now bring the lesson forward. The modern banking system is more sophisticated than the system of 1929. But sophistication does not eliminate fragility. It often moves fragility to places people do not see. Banks today are interconnected. They hold securities. They depend on funding markets. They interact with derivatives. They rely on confidence at a speed that would have been unimaginable in Harold's time. In 1930, people had to line up outside a bank. In 2023. Deposits could leave a bank digitally in hours. That makes the machine faster. It does not make it less fragile. One of the central risks in recent years has been interest rate risk. When rates rise quickly, the market value of long-duration bonds falls. Banks that bought long-duration securities in a low-rate environment can hold large unrealized losses when rates rise. As long as depositors stay calm and the bank does not have to sell, those losses can remain unrealized. But if depositors demand their money, the bank may need to sell assets at a loss. Selling reveals the loss. Revealed losses create fear. Fear creates more withdrawals. Withdrawals force more sales. The loop feeds on itself. This is what made the collapse of Silicon Valley Bank so instructive. It was not simply about one badly managed institution. It was about a structure where long-duration assets met short-duration liabilities in an environment of rising rates and fast-moving deposits. That is the kind of dynamic I pay attention to. Not headlines, not personalities, not political slogans, dynamics. What are the assets? What are the liabilities? What is the duration mismatch? What happens if confidence changes? What is the policy constraint? Who takes the loss? Those questions reveal the machine, and right now, the machine has a difficult policy constraint. If inflation remains a problem, central banks may need to keep rates high. High rates pressure bank balance sheets that hold long-duration assets. If central banks cut rates aggressively to relieve banks, inflation can reignite, the currency can weaken, and savers can lose purchasing power through a different channel. That is the difficult part of late-cycle debt systems. There is no painless path. One path stresses banks through interest rates. The other path stresses the currency through inflation. This is why I do not think in terms of certainty. I think in terms of probabilities and consequences. If I am wrong about the timing, will I still be okay? If I am wrong about the type of crisis, will I still have options? If one institution fails, am I dependent on it? If one currency weakens, am I entirely exposed to it? If markets are closed for a period, can I function? That is not fear. That is decision quality. A common mistake is to think preparation means predicting a collapse. It does not. Preparation means understanding that systems can fail under certain conditions and not putting your entire life on the assumption that they never will. I do not need to predict the exact year, bank trigger, or policy response. I need to understand the structure. A structure built on short-term liabilities and long-term assets is stable when confidence is strong and fragile. When confidence breaks, a deposit is a claim, not a vault. Insurance is a stabilizer, not an unlimited guarantee. Bail-ins are legal mechanisms, not imaginary theories. Physical cash, treasuries, money market funds, gold foreign accounts, and real assets each solve one problem while creating another. And the best defense is not blind trust or blind panic. It is thoughtful diversification. It is documentation. It is staying within the law. It is keeping liquidity where you can actually access it. It is not placing all of your money in one institution, one account type, one currency, one country, or one assumption. The biggest danger is not that banks are evil. The biggest danger is that people misunderstand what banks are. A bank is a levered institution that borrows short and lends long. It is part of the credit machine. It can be well run or poorly run. But even a well-run bank depends on confidence and liquidity. If enough people want out at the same time, not everyone can get out at once. That is the old truth. It was true in 1930. It was true in 2008. It was true in 2013. It was true in 2023. The details changed. But the principle remained: history does not repeat exactly, it rhymes, because human nature and financial structures keep interacting in similar ways. People chase yield when they feel safe. Institutions stretch duration when rates are low. Regulators reassure the public until they are forced to change the rules. Depositors believe access is the same as ownership. Then confidence turns and everyone remembers liquidity at the same time. That is when the hidden structure becomes visible. If you are Harold in Nebraska, the lesson comes too late. You are standing outside the bank, seeing the vault through the glass, learning that your claim is not the same as your cash. If you study the pattern before it happens, you can act with more clarity. You can keep some emergency liquidity outside any single point of failure. You can keep deposits within insured limits where appropriate. You can understand the difference between insured deposits, uninsured deposits, securities, direct government obligations, and physical assets. You can reduce unnecessary concentration. You can ask better questions of your bank, your brokerage, and your advisors. You can stop assuming that convenience equals safety, and perhaps most importantly, you can stop outsourcing your understanding, because in every crisis, the uninformed are the easiest people to sacrifice. That sounds harsh, but systems do not protect people because they are innocent. Systems protect people according to rules, incentives, priorities, and hierarchies. If you do not know where you sit in that hierarchy, you are taking risk without seeing it. The modern financial world is full of promises that feel certain until conditions change. Deposit insurance, emergency facilities, regulatory oversight, central bank liquidity, government backstops, these can all matter. They can all reduce risk. They can all prevent collapse in many scenarios, but none of them eliminates the core reality. Your money is only as accessible as the structure holding it allows it to be. That is why I believe the right mindset is not panic. It is radical clarity. See the system as it is, not as you wish it were. Not as marketing describes it, not as politicians summarize it as it is. A bank deposit is a claim. A bank is a counterparty. A financial system is a machine. A crisis is a test of where claims sit in the hierarchy. And preparation is the art of having enough optionality that one failure does not become a personal disaster. Harold's mistake was not that he trusted a bank. In normal times, trusting a bank can be reasonable. His mistake was that the system gave him no alternative, no protection, no diversification, and no understanding of the risk he was taking. Our advantage is that we have the history, we have the autopsy, we know the pattern. The question is whether we learn from it while learning is still cheap. The next banking crisis may not look like 1929. It probably will not. It may involve digital withdrawals instead of lines on the sidewalk. It may involve a regional bank instead of a farmtown bank. It may involve a bail instead of an outright failure. It may involve emergency lending that protects some depositors and not others. It may involve inflation that saves nominal balances while destroying real purchasing power. The form can change, the principle does not. When confidence breaks, the distinction between owning money and having a claim on money becomes very important. Most people never study that distinction until they have to. By then, the doors may already be closed. The purpose of studying history is not to become afraid of the future. It is to reduce surprise. Surprise is what destroys people. Not because the event was impossible, but because they never imagined that the system could work differently from what they assumed. The bank did not fail because Harold was foolish. It failed because the structure was fragile, confidence broke, and he had all his trust in one claim. The same kind of mistake can be made today with more modern tools: a high balance in a single uninsured bank account, all liquidity inside one institution, no physical emergency cash, no understanding of settlement periods, no awareness of brokerage structure, no plan for access interruption, no diversification across assets that behave differently in inflation, deflation, and liquidity crises. These are not dramatic mistakes. They are quiet mistakes, and quiet mistakes are the ones that feel safe until they are not. If there is one principle I would leave you with, it is this: do not confuse a smooth system with a riskless system. Smooth systems can hide risk better than broken systems because they create habit. Habit creates complacency. Complacency creates concentration. Concentration creates vulnerability. The more seamless your access feels, the more important it is to understand what happens if access is interrupted. That is the lesson of 1929. That is the lesson of Cyprus. That is the lesson of every bank run, every capital control, every emergency facility, every deposit freeze, every policy surprise. It is not that banks should never be used. It is that banks should be understood, use the system, but do not worship it. Benefit from credit, but understand leverage. Use deposits, but know the limits. Use technology, but remember that digital access can be revoked faster than physical access ever could. Own claims, but know who owes them and what happens when they cannot pay. Most people want certainty. Markets and banking systems do not give certainty, they give conditions. Under normal conditions, the machine works. Under stress, the hierarchy matters, and under extreme stress, optionality becomes priceless. That is why the smartest approach is not to predict doom. It is to build resilience. Resilience means that if one bank closes, your life does not stop. If one account freezes, you have another path. If inflation eats cash, you have assets that can respond. If deflation creates liquidity scarcity, you have some liquidity. If a government changes rules, you are not completely trapped in a single structure. If a counterparty fails, your entire financial life is not dependent on that counterparty's survival. That is how I think about storing cash when banks fail, not as a single answer, as a system. A system of liquidity, claims, physical assets, government obligations, diversification, documentation, and legal compliance. A system designed around the reality that no asset is perfect and no institution is permanent. Once you understand that, you are no longer standing outside the bank, knocking on the glass, hoping someone lets you in. You are not guaranteed safety, no one is, but you have moved from blind trust to informed resilience. And in a world where financial machines are more complex, more leveraged, more interconnected, and faster than ever before, informed resilience is not paranoia, it is common sense. The next crisis will come with a different name. It always does. People will say no one could have seen it coming, they always do, but the mechanics will look familiar to anyone who has studied them. Too much leverage, too much confidence, too much concentration, too many short-term claims against long-term assets. A trigger, a rush for liquidity, a policy response, a redistribution of losses. And afterward a new story explaining why it was unique. But the pattern is old, and if you understand the pattern, you do not need to be the person who is surprised. You can be the person who prepared before the sign was taped to the glass.